In 2021, many large tech businesses went public through IPO, direct listings, and specifications. With very few exceptions, most were utter flops after receiving a lot of fanfare. To date, many of them have lost at least half of their value, and others have lost as much as 70%, destroying hundreds of billions of dollars in shareholder value. One of the reasons is that many of these firms were burning cash to fuel rapid expansion. When it became clear that the Feds would raise interest rates, these equities began to lose appeal as it became more difficult to support their cash burn. Coinbase looked to be one of the strongest places of the new IPOs in such an atmosphere. They were not only rapidly expanding, but also extremely profitable. They should be able to endure a Fed tightening cycle if anyone can. Unfortunately, this has not been the case, as the share price has been slashed in half since its direct offering in April of last year. Now, famed short seller Jim Chanos has said that he is short Coinbase and believes that there is much more downside. Of course, we should take his statements with a grain of salt, since he is the same individual who drove his company nearly bankrupt with his multi-year Tesla short. However, in this case, he raises some intriguing issues regarding Coinbase's business model, which might put the company under huge pressure in the future years. We will look at how Coinbase produces money and why Jim Chanos decided to short their stock in this video. But before we proceed, let me welcome you to the Smart Stocks Academy channel. And to be the first to know when a new video is released, don't forget to hit the like button, subscribe, and the notification bell right next to it. So if you're ready, let's get to the video. Coinbase is a cryptocurrency platform where you can buy, sell, and deal with Bitcoin. It was one of the first crypto exchanges created in 2012 and has since become the market leader. Its users own about 10% of all cryptocurrencies in the world. They generate money through charging transaction fees on cryptocurrency exchanges, as well as fees from different subscriptions and other value-added services. As we can see in this graph, transaction fees account for 93% of their overall revenue, with retail customers accounting for 95%. So while they claim to be a diverse crypto economy firm, for the time being, they're mostly an app that people use to speculate on crypto and, much to a lesser extent, to enable payments in the real economy. The fee structure at Coinbase is a little convoluted, so we'll look at how much you pay for a hypothetical $100 Bitcoin exchange. They really offer two platforms, Coinbase and Coinbase Pro. Coinbase charges a 3.5% fee every time you purchase or sell cryptocurrency. So if you buy $100 in Bitcoin, the price immediately drops to $96.50. The costs on Coinbase Pro are substantially lower. You pay roughly 0.5% for transactions under $10,000, and the fees reduce as a percentage the greater your deal is. The revenue from transactions is significantly connected with the price of Bitcoin and other cryptocurrencies. When Bitcoin is in a bull market, the value of their clients' holdings rises since they charge a percentage, which boosts their revenue. Furthermore, bull markets tend to raise the general enthusiasm around cryptocurrency, causing more individuals to establish accounts and begin trading. While a 5% charge may not seem like much, it can mount up. If you frequently trade cryptocurrency, even if you simply purchase or sell once per month, you will accrue a 6% cost over the course of a year. This puts you at a significant disadvantage, since you might quickly lose money even if crypto values climb marginally. Today, almost all US stock brokerages provide commission-free trading. But of course, nothing is ever truly free, and market makers like Citadel take a few cents from each trade conducted on ostensibly free platforms. However, most of the time, this is a negligible sum reflecting less than 1/10 of the order value. Even when using Coinbase Pro, the costs charged by Coinbase are significantly greater. Of course, because cryptocurrency is a lot newer asset class than equities, which have been around for millennia, you might expect greater fees in the beginning. However, Coinbase's costs are significantly higher than those of other cryptocurrency brokerages. Binance, the largest cryptocurrency exchange outside of the United States, charges costs that are 5 to 10 times lower than Coinbase, while providing almost equal functionality. Jim Chanos believes that Coinbase's high fees are unsustainable and that the revenue may drop even if the crypto markets do well in the future. Coinbase's user base and income have significantly expanded in recent years as the crypto markets have surged. Their income surged 15-fold from $500 million to over $8 billion in 2021. Their transaction costs as a proportion of sales is only roughly 15%, which implies they're charging you about 7 times more than their internal costs. Despite spending substantially on sales and marketing to recruit new customers, this has allowed them to produce net profits. It also enables them to lavishly reward their senior personnel, with CEO Brian Armstrong earning $60 million in total remuneration in 2020. That is more than 4 times what Apple CEO Tim Cook earned. Despite charging some of the industry's highest prices, they have been able to grow swiftly, reaching about 90 million subscribers by the end of 2021. Part of the reason for this is that their status as one of the oldest and most reliable crypto platforms. In 2021, they became the first pure-play crypto platform to go public. They employ cold storage to retain their clients' funds, making hack losses very impossible. Their strong security measures make it one of the safest platforms. If you establish an account with Coinbase, you can be confident that your cryptocurrency is secure and that you will not be defrauded. In 2020 and early 2021, many investors were coming into cryptocurrency for the first time. If you're a newbie, you're probably prepared to spend a few additional fees for a peace of mind rather than risking it with a dodgy offshore exchange. Coinbase was the only game in town for that in the beginning. But after seeing the exponential surge in huge profit margins Coinbase was producing, nearly every retail brokerage and fintech business jumped on board. Today, you can trade cryptocurrency on PayPal, Robinhood, and nearly every other retail brokerage, and their transaction costs are either competitive with or lower than those of Coinbase. There are also several firms that are raising billions of dollars in venture funding to spend on client acquisition. This is exemplified by Crypto.com paying millions of dollars to begin an ad with such a high production quality that it could be easily mistaken for a movie trailer. This is the same business that paid $700 million to remodel the Los Angeles Lakers arena to prominently showcase Crypto.com. Crypto trading is hardly rocket science. Virtually any technology business or even a startup can develop a new trading platform that can do nearly everything that Coinbase does. When there is so much competition for a commodity product like this, a race to the bottom is unavoidable. Competitors must spend more money on advertising as their profit margins contract because they must undercut each other in pricing. At the same time that competition has increased, Bitcoin has been on a turbulent slide, shedding 25% of its value in the last year. In 2021, Coinbase had a net profit of $3.6 billion. Based on their pricing, they have a price-to-earnings ratio of around 12, making them appear to be a bargain company. However, Jim Chanos contends that these earnings data are mostly unimportant because these were exceptional circumstances. When a corporation produces abnormally significant earnings in a short period of time, this is referred to as over-earnings in the investment sector. One of the finest instances of this is Moderna, which presently has a price-earnings multiple of 6, making it appear to be a deep bargain company. But these earnings are clearly not sustainable, as everyone will soon get vaccinated and demand will collapse. When a company's revenue more than doubles in a few years, it is extremely risky to extrapolate this into the future. This issue is exacerbated by the fact that corporations tend to IPO when they believe they would receive the highest valuation. Many of the technology firms that went public in 2020 and 2021 were COVID beneficiaries, either because they provided work-from-home services or because they were losing money and profited from the Fed's money printing. At this moment, Coinbase's sales and earnings were increasing, and its stock would be an easy sell on Wall Street. This allowed early investors and company executives to sell the shares at high prices. Co-founder and CEO Brian Armstrong wasted no time, dumping about $300 million in shares on the first day of trading. He may even have used some of those earnings to purchase the $133 million mega home in Bel Air, California, the 4th most expensive real estate transaction in the state's history. There is a strong relationship between IPOs and stock market prices. When stocks are expensive, corporations are more inclined to issue more shares to take the advantage of high pricing. So, what are your thoughts about Coinbase? Do you agree with Jim Chanos that their finest days have passed? Tell us in the comment section down below. And with that, today's video comes to a close. If you haven't already, show your love and support for this video by hitting the like button, subscribing, and turning on the notifications to be the first to know when a new video is released. Thank you for taking the time to watch, and we hope you had a wonderful time. We hope to see you again in our next video.